Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over something that is in FAR Area 2. Now, in the previous video, we talked about FAR Area 2 Section C, and we covered how to calculate the carrying amount for inventory using different costing methods. Now, something that seemed to be pretty important as well with that is being able to calculate the cost of goods sold with those different costing methods. So this isn't specifically a blueprint topic, it's a continuation of the previous blueprint topic, but from the standpoint of cost of goods sold. So we're going to go over how to calculate the cost of goods sold for inventory using various costing methods. So we're going to be doing that the SuperfastCPA way, which is diving straight into the questions. What are you going to be doing on test day? You're going to be answering multiple choice questions and sims. You're not going to be tested on how well you can watch a lecture. You're not going to be tested on how well you can read a textbook. You need to know how to do the multiple choice questions, and that is a big strategy behind SuperfastCPA, is going straight into the questions to learn the material. If you want to learn more about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam, and again, we will teach you how to be effective and efficient with your studying so you don't waste months or even years of your time trying to pass this exam. Also, just letting you know, we will only be going over 5 questions in today's video, whereas SuperfastCPA Pro members will have access to the full 10-question video when we post it in the members forum. So if you like this and you like our other videos and our other products, make sure you become a SuperfastCPA Pro member and you'll get access to even more resources to help you pass these exams. With all that said, let's dive straight into the questions. All right, here we are at question 1. And again, just a reminder, we are still going over inventory and the different costing methods, but instead of talking about the carrying amount of inventory, we're focusing more on the cost of goods sold. So all of these questions will have to do with that. Let's go ahead and dive into question 1. One thing that we always like to point out is, and this is a good habit to be in, is to read the last part of the question first to give yourself context for the rest of the question. So what is the cost of goods sold for Granite Corp using the periodic LIFO method? Okay, so we're going to use the periodic LIFO method to figure out cost of goods sold. So let's go up here. Granite Corp uses a periodic inventory system and the LIFO method for valuing its inventory. During the year, the company had the following inventory transactions. They started with 200 units at $10 each at the beginning that's the beginning inventory. They purchased 300 units at $12 each on March 1st, and on July 20th, they purchased another 100 units at $15 each, and by the end of the year, they had sold 450 units. So with that, we have to figure out the cost of goods sold using the periodic LIFO method. Now, if you watch the previous video, a lot of the stuff that we go over in this video will be things that kind of have to do with what we already talked about in that video. So I think that it will be easier if you've watched that previous video. But if you have no idea how to do this, that's okay. We're going to dive straight into the answer to learn how this works. All right, here we are. The answer is B. $5,600 is the cost of goods sold. This is quite simple, quite straightforward. So let's dive into it. There's not too much to go over. Now, just a reminder, we talked about this in the previous video. Periodic LIFO is where you calculate the cost of goods sold and the carrying inventory and everything at the end of the period. You're not doing it as you go throughout the month. You only calculate it at the end of the period, whether that's a month or a quarter or a year, whatever the case is. So with that in mind, we have to take into account the total amount of units that were sold. So 450 units were sold. So with that knowledge, we go down here. We know that we're using LIFO, which is again, last in, first out. So the most recent things that we purchased are going to be the things that we sell first. So with that in mind, we go here, 100 units at $15. What is that? That is the July 20th purchase because that was the most recent purchase. And then we can use 300 units from the March 1st purchase. And if you can see, that has used up all of the units that we purchased throughout the year. And then there's still 50 units left from the 450. So we have to use 50 of the units from the beginning inventory. So again, we're starting at the most recent purchases and working our way up to the oldest purchases or the oldest inventory. But we're not doing this perpetually. We're just taking into account all of the units that were sold and starting from that point. So we have 50 units from the beginning, 300 units from March 1st, and 100 units from July 20th. You add that all up together, that was how much was sold, and it's $5,600 of inventory was sold. So that means that that was $5,600 of cost of goods sold. Again, pretty easy because all you have to do is know how many units were sold, and then based on those units, work your way up from the purchases throughout the year to figure out how much the cost of goods sold was. So let's go to the next question to learn a little bit more about a different costing method. All right, here we are at question 2. As always, read the last part first. What is the cost of goods sold for Slate Co using the weighted average method? Okay, so we've never seen the weighted average method. We didn't talk about it in the previous video because it seems to be more focused on cost of goods sold if you're going to be tested on the weighted average method. So let's go up here. SlateCo uses the periodic inventory system and the weighted average method to value its inventory. The company had the following inventory transactions during the year. So they started with 200 units at $15 each. They purchased 300 units at $18 each in March. In June, or on June 10th, they purchased 500 units at $20 each. And on October 15th, they purchased 200 units at $25 each. And they sold a total of 800 units throughout the year. So this is quite similar to the periodic LIFO method as far as the information that we're given, because we are doing this at the end of the period. So we're taking into account all units that were sold, 800 units, not perpetually, not as you go, just at the end of the period. So 800 units were sold. We have to figure out what the cost of goods sold was using the weighted average method. Now, you could probably think through this just by thinking about what weighted average means. So if you want, go ahead and pause the video and give it a try yourself to see if you can figure out what the answer is. If you don't know how to do it though, that's okay. We're going to dive straight into the answer to learn how to do it. All right, here we are. The answer is C, $15,600. So that is the cost of goods sold using the weighted average method. So let's walk through this. The weighted average cost per unit is calculated by dividing the total cost of inventory available by the total units available. So we add up the whole cost of the inventory throughout the whole year and divide it by all the units that there were throughout the year to see how much each unit was worth using the weighted average. And then from there, we can figure out how much the cost of goods sold was. So let's go here. So we start with the beginning inventory. That was 200 units at $15 each. That's $3,000. March 5th purchase was 300 units at $18 per unit. That gives us $5,400. June 10th purchase was 500 units at $20 per unit. That's $10,000. And October 15th purchase was 200 units at $25 per unit. So that's $5,000. So what we do is we add up the total cost of the inventory, and that includes the beginning inventory and the purchased inventory. And that gives us $23,400 of inventory that is available, total cost. And then the total units available is all of these units added up together. So 200 plus 300, that's 500, plus 500, that's 1,000, plus another 200, that's 1,200 units. So 1,200 units. So we take this total cost of inventory divided by the total units available, and that gives us $19.50 per unit is the weighted average cost per unit throughout the year. Now that we know that weighted average cost per unit, we can then apply that to how many units were sold throughout the year. So we take the units that were sold, that was 800, multiply it by this average that we figured out, $19.50, and that gives us $15,600 of cost of goods sold using the weighted average method. So this is another way you can figure out the cost of goods sold. This is another periodic method, because periodic, if you have noticed this from the previous video and from this video, are methods that you do it at the end of the period instead of continually doing it throughout the period, which would be perpetual. So that is how to do the weighted average cost of goods sold. Let's go to the next question. All right, here we are at question 3. What is the cost of goods sold for the sale on October 5th using the moving average method? Okay, so this is another method that we haven't talked about in the previous video. Blue Ridge Traders uses a perpetual inventory system and the moving average method for valuing its inventory. The company had the following inventory transactions during the year. They started on January 1st with 100 units at $20 each. They purchased 200 units in March for $25 each. They sold 150 units on June 15th. They purchased in August 300 units at $30 each, and they sold another 250 units in October. So we have to figure out what the cost of goods sold was for those 250 units that were sold in October. But this is the moving average method. If you have never seen that before, then we're going to go straight to the answer. If you've seen this before, pause the video and think through this. Basically, I just have to say this. Basically, think of this as the weighted average method, but perpetually. Think about the previous video where we talked about perpetual LIFO and perpetual FIFO. Kind of think about that, but apply it to the weighted average method, and then you would have the moving average method basically. So again, if you want, go ahead and try yourself. If not, let's go ahead and look at the answer together. All right, here we are. The answer is B. $6,945 is the cost of goods sold using the moving average method. So as I said, this is similar to the weighted average method, but instead of being periodic, it is perpetual. So let's walk through this. Under the moving average method, the average cost per unit is recalculated every time there is a new purchase. So we are still calculating an average, but we're changing it every time we have a new purchase. This average cost is then used for the next sale until a new purchase changes the average cost per unit again. So let's walk through that. So we start with beginning inventory of 100 units at $20 each. That's $2,000 of inventory. On March 1st, they purchased 200 more units at $25 each, and if you multiply that, that's $5,000. So now the new total units is 300 units. And the new average cost per unit is this $2,000 plus this $5,000 divided by the new total units. So $7,000 divided by 300 units gives us $23.33 per unit. So right now, the average per unit as of March 1st is $23.33 per unit. Now we go to June 15th and we haven't had any purchases since then. We sell 150 of those units. So we sell 150 units at that $23.33 per unit, and that gives us $3,500. It technically was $3,499.50, but if you times that by 2, as in, this is one half of the 300 units, then it would get you $6,999. So obviously you need to round it to $3,500 because if you times that by 2, that would give you $7,000, which is what was up here. Anyway, so $3,500 was sold. That leaves 150 units left over. These are still valued at $23.33. That is still the inventory that is sitting there. So that means that $3,500 is still sitting there. And then we go to August 10th for a new purchase. We purchase another 300 units at $30 each. That's $9,000. Now we have a new total units of 450 units because we still have these 150 units left over from March 1st and also the beginning inventory together. And now we have 300 more units, so 450 units, and we can use that to figure out the new average cost per unit, which is again this $3,500 that was left over after the June 15th sale, and then the new $9,000 that were purchased on August 10th. That gives us $12,500 divided by 450 units. That gives us $27.78 per unit. So that is the new moving average as of August 10th when we purchased more units. So $27.78. Now we can finally apply this to the October 5th sale, which was a sale of 250 units. So we sell 250 units at $27.78, and that gives us $6,945. And that's rounded. I think it was like $6,944.4444, but it's $6,945. So cost of goods sold, October 5th sale, $6,945. But you can see that we had to work through this perpetually to get to that point because we would not have known if we hadn't done all these other calculations what the cost per unit or the moving average cost per unit was when we got to October 5th. So again, this is a little bit different than the weighted average where instead of doing it all at the end of the period, every time you do a new purchase, you are recalculating the average of the inventory based on the new units and the new cost of those units and adding it all together. So that's the moving average way to calculate cost of goods sold. Let's go to the next question. All right, here we are at question 4. A manufacturing company operates in an environment of steadily increasing prices. That would be an inflating economy due to rising material costs. If the company uses LIFO instead of FIFO for its inventory valuation, which of the following statements is true regarding its cost of goods sold and ending inventory values compared to FIFO? So we're comparing LIFO to FIFO. What is the cost of goods sold going to be in a rising economy, the economy where things are costing more? Is LIFO going to have less COGS or higher COGS? Is it going to have higher inventory or lower inventory compared to FIFO? Think about this. Think what LIFO and FIFO are about, and when you're ready, come back, we'll look at it together. All right, here we are. The answer is A. LIFO will result in a higher cost of goods sold and a lower ending inventory value compared to FIFO. So let's think through this. Again, this is in a rising economy where things are costing more. It's an inflation. In an inflating economy, prices of goods are rising over time. Under the LIFO method, the most recent and therefore higher priced inventory items are recorded as cost of goods sold. This results in a higher cost of goods sold compared to FIFO, which uses the older and therefore, in this economy, lower priced inventory items. Consequently, because LIFO assigns higher costs to cost of goods sold, it leaves the remaining inventory value at older, lower costs, resulting in a lower ending inventory value compared to FIFO. This also means that LIFO tends to produce lower net income due to the higher COGS in an inflationary environment. So again, if you think about that, I think that's pretty clear the way it was explained there, but with LIFO, you are selling the most recent things first. And if the economy is inflating, that means each time you purchase something, it's going to be more and more and more expensive. So you're selling those more expensive things first with LIFO. And that means that your cost of goods sold is going to be higher and that your inventory is going to be lower because the inventory that's still there is the older inventory that costs less than the new inventory that you just sold. And then, of course, that means that if you have a higher cost of goods sold, that means that that's a higher expense, so that's going to lower your net income as well. So those are some things to think about when it comes to LIFO and FIFO in different kinds of economies. let's go to the next question. All right, here we are at question 5. Let's read the last part. What is the total cost of goods sold for the period? Okay, so that's something that we've been talking about the whole time. Let's read through this to figure out what's going on. Brightline Manufacturing produces high quality furniture. During the current period, the company made the following inventory related expenditures. Beginning raw materials was $20,000. Raw materials purchased was $50,000. Direct labor costs, $80,000. Factory utilities, $6,000. Depreciation on factory equipment, $12,000. Insurance on delivery trucks, $4,000. Office supplies, $2,500. And sales commissions, $3,500. So a lot going on there, a lot of different expenses. The ending balance of raw materials was $18,000. There was no beginning or ending finished goods inventory. So with all that information, again, now we have to figure out the cost of goods sold. So this is a little bit of a different way of looking at it. We've been talking about different costing methods like LIFO, FIFO, weighted average for most of this video and the previous video. But right here, we're only given what the costs were for inventory, or, some of them are going to be used for inventory. So what is the cost of goods sold in this situation? You could probably think through this because it's not too difficult. Just think about what is needed to make this inventory. Pause the video, think through this. If you don't know how to do it, that's okay. We're going to go to the answer when you've had a second, and we'll look at the answer together. All right, here we are. The answer is D. $150,000 is going to be the cost of goods sold. So again, this is a little bit different of a question, but it's still important to know and to think about this. Manufacturing costs include the costs necessary to produce the inventory and get it ready for sale. So whatever the costs are to actually create the inventory and have it ready to be sold, that's what we're talking about right here. These are raw materials, so the materials used to make the inventory, direct labor, the people who directly created the inventory, and then manufacturing overhead directly related to the production. So anything that is overhead that is directly related to these things being created. So let's walk through this. First, we have to calculate the total raw materials used. The beginning raw materials was $20,000. We add the purchases, so that's $70,000, but we know we ended with $18,000. So that means that we use $52,000 of raw materials to create the inventory. Now that we know that, we can total up all the manufacturing costs. So we had raw materials of $52,000, direct labor was $80,000, and that was given to us. Factory utilities is $6,000. This is an overhead cost that is used specifically for running the factory that is making the inventory. So that is a manufacturing overhead cost. And then depreciation on factory equipment, again, another expense that is directly related to the creating of this inventory. So we add all that up together, and that gets us $150,000 of manufacturing costs. Now, it did say all the goods that were produced were sold, and we didn't start with any at the beginning. So we had no beginning inventory, we had no ending inventory, which means that everything that we used to produce, all the costs that there were to produce this inventory, since all of them were sold, they're all cost of goods sold. So the cost of goods sold in this situation equals the manufacturing costs, which is $150,000. It may not always be that way where all of the inventory was sold at the end of the period, but this is another way to look at it. Remember that cost of goods sold is not just purchasing totally finished products. It also has to do with creating the products and using materials and things like that. So just wanted to talk about that with the inventory. And with that, we've gone over 5 questions. Before we go any further, let's do one more part of the SuperfastCPA process, which is called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 different questions trying to teach you how to do cost of goods sold for the LIFO periodic method. Or you've seen 2 or 3 questions trying to teach you how to do the weighted average cost method for cost of goods sold, or whatever the case may be. You see these things that keep popping up, and you know that they are important because, again, you've seen them multiple times. So you take a moment, you write down these pillar topics, summarizing them in your own words, and as you do this each day, you will have pillar topics and the most important things known for the exam so that you can, of course, have that in your head as you go into the exam. It's kind of a way to inform yourself on what is most important for the exam. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Again, this is kind of just a summary, a straightforward summary in your own words of what is most important. So let's walk through this. Periodic LIFO, cost of goods sold. Under periodic LIFO, cost of goods sold is calculated using the cost of the most recent inventory purchases first until the total quantity is sold. And remember, in periodic LIFO, you're just given the total amount of units that were sold. So you use that amount and slowly go backwards from the most recent purchases until you've used up all those units, and that will inform you how much the cost of goods sold was for LIFO periodic. weighted average cost of goods sold. Weighted average cost of goods sold is determined by calculating the average cost per unit of all inventory available during the period and multiplying it by the number of units sold. The average cost per unit changes only at the end of the period. So this is different than the moving average cost of goods sold. Weighted average cost is another periodic costing method where it's all done at the end of the period. So you have to take into account all the inventory that there was, how much that inventory cost, and how many units there were. Divide the cost by the units, and that will give you the weighted average cost per unit, and then you multiply that by how many units were sold. Now, the moving average cost of goods sold is similar, but it's from the perpetual perspective. Under the moving average method, cost of goods sold is calculated using an average cost per unit that is recalculated each time a new purchase is made. So each time you add more inventory at whatever cost that was, you add it to the total amount, and you have to figure out the average over again. This method continuously adjusts the cost of goods sold based on the latest average cost per unit. Now, as far as LIFO and FIFO in different economic conditions, and you can flip this because we talked about an inflating economy, but you can talk about this with an economy that is going down as well. In a rising price environment, LIFO results in higher cost of goods sold and lower carrying inventory compared to FIFO. In a falling price environment, LIFO produces lower COGS and higher carrying inventory compared to FIFO. And if you think about that, that makes sense. If you're in an economy where the cost of materials is going up and you're using LIFO, that means that you're selling the most expensive stuff first, which means that your inventory is going to be lower, your cost of goods sold is going to be higher compared to FIFO. Now, think about for FIFO. With FIFO, you're doing the least expensive stuff, and again, this isn't an inflation economy, you're doing the least expensive stuff first. So your cost of goods sold is going to be lower, but your ending inventory is going to be the more expensive stuff that's still sitting there, and that means that you have a higher ending inventory. And you can flip that in a different economy where if the prices were going down, again, that flips. Just think about that difference there, and that will be helpful. Now let's go to cost of goods for manufacturing costs. Now, this isn't something that's as big as the costing methods that we went over, but this is still important to think about and to realize that there is more to cost of goods sold than just these costing methods. To calculate cost of goods sold from manufacturing costs, you include only direct materials, direct labor, and manufacturing overhead that has specifically to do with the creating of these inventory of these units. Costs such as administrative expenses, marketing, and other non-production costs are not included in cost of goods sold. So these are a whole bunch of different ways that you need to think about cost of goods sold when it comes to inventory. And with that, that is the end of the video. I hope this was helpful. Before you go, make sure you go check out our free 1-hour webinar training on SuperfastCPA.com. Again, we will teach you the key ingredients to passing the CPA exam. We will show you how to be effective and efficient with your studying. And after you watch that webinar, you're going to want to learn more. And just a reminder, if you become a SuperFast CPA Pro member, you will have access to the full 10 question videos that we create of these videos that only Pro members can access. And that means you can get more practice and more understanding from watching those videos and getting those walkthroughs. So remember, become a SuperFast CPA Pro member and you will get access to a lot of other resources that can help you through these exams. If you liked the video, make sure to like it and leave a comment. And again, with all that said, thank you for watching. I hope this was helpful, and I will see you in the next video.